So this is being recorded about a week prior to it coming out. So the rates I'm about to quote in this video are probably going to be a little dated. But at the moment, at the time of this recording, mortgage rates are at about 6.67. That's the 30-year fixed, of course. And the moral of that story is that that rate has been about the same for some weeks now. Ticking up, ticking down, an eighth of percent here, eighth of percent there. But arguably, it's been staying roughly in the same range of around 6.4, 6.5 to 6.6. What I want to cover in this video with this mortgage rate update is a little bit about the affordability issue in the housing market, what these mortgage rates can mean for the overall economy, and more importantly, action steps that you can take to increase your affordability for housing. Many of us are still in the housing market or on the fence in the housing market, and we've had a significant drop in the quality of house that we can afford in just the last 12 months. It's been astounding, to be completely honest. I've witnessed my own purchasing power just through calculations, not that I've been buying at this time, but just through calculations, drop over $100,000. That is a total difference in the neighborhood distance you can live. Like, that's a dramatic difference in the home you can own. So I want to bring content in this video that's going to be useful for you, that can empower you to take action steps that can actually manifest on paper in underwriting to get you qualified for more home. This is JP from Blueprint for Prosperity. We're going to jump right into it. So the mortgage rates are relatively flat at the moment, and unfortunately they're flat in a high area. 6.6-ish, 6.5 is pretty rough. If you got prime credit, you probably will be down somewhere in the 6.2, 6.3 range. Still pretty nasty, to be completely honest, compared to what we're used to the last 5, 7, 10 years, to be honest. If we got our wish, those of us that would be in the real estate market that want to see rates come down and make real estate more affordable, the problem with that situation is it would have economic calamity. It would be economically catastrophic in many ways if the mortgage rates came down the way that we might desire them to. What do I mean when I say that? In order for mortgage rates to start to come down, that means one of two things have taken place, or potentially two of two things have taken place. The Federal Reserve has started to cut rates, which honestly isn't a good thing, potentially, or the 10-year Treasury has started to drop precipitously, which arguably is not the best thing in the world either. The reason the Fed's cutting rates is going to be a problem if that happens anytime soon is because inflation is not under control. It could be argued that the Fed has still not quite done enough to get inflation where it's going to need to be soon enough to get inflation under control before a recession kicks in. I plan on shooting a video that talks about a recession during inflationary times called stagflation. It's an absolute nightmare, and I'm probably going to cover a whole video on that later. If the Federal Reserve does that trigger and mortgage rates come down because the Fed has started to pull rates down, then that means that we are likely dealing with the Federal Reserve pivoting in concerns for the economy's health while letting inflation start to go crazy. What many of us don't have to understand is that even if you get your wish on mortgage rates, you're probably going to get absolutely torched on home prices because we still have an inventory shortage. We still don't have enough homes by millions. That means if rates come down, everybody and their mama is going to be able to afford a house again. And as equitable as that sounds, it's disastrous for the housing market because prices haven't really dropped in most markets. Prices are still really bad. So that means that we have modest price increases going on projected right now, even with mortgage rates up in the 6s. Can you imagine if they drop below 6, drop below 5.5? You're putting hundreds of thousands of buyers back in the pool. It's going to be crazy. Y'all fill that in for yourselves. It's going to be a problem. So the other end of that coin, the 10-year Treasury starts to go down. You have a similar situation going on where that's going to affect the investment markets and have its own, whatever the case may be. The housing market itself cannot sustain rates to go down at the moment with the inventory issue we have. The Federal Reserve cuts rates prematurely before inflation is completely under control. We got another problem on our hands. So with that out of the way, hopefully that shifts our perspective to respecting 6.5% interest rates right now. Cool. Excuse me. Cool. We'll say we take that for the moment. What can you do to empower yourself to still buy a home that you truly desire at these interest rates? 3 major areas that you can control or at least have strong influence on that can steer your affordability. The number one thing that you can do is control your credit. The next thing you can do is control your DTI. And the next thing you can control is your down payment. Those 3 factors will lever against or for you, your affordability. If you can get all 3, then you might be in the money. But if you look at an affordability calculator, those are the 3 mechanisms that you have the most control over. You can't control interest rates very much, though I'm gonna give you a bonus at the end of this video of how you can at least steer it in your favor. But those 3 factors I just named are going to be the 3 factors that can help ensure you the best rates possible, the most affordability possible. Let's dive a little bit deeper on each of those 3 before we close out on this video. Credit. 760 and up is the new prime. At some point in time, it used to be like 740. Now it's 760. And to be honest, if you look at the FHFA's loan rate price adjustment situation, I shot a video on that about a week and a half, 2 weeks ago. 780 is actually their new prime. They're considering a whole nother bracket for 780, and they get the cheapest loan level price adjustments out of the bunch. 760 to 780 is the new roof. FICO, middle FICO score out of your tri-merge report. All 3 major bureaus FICO scores. The middle one needs to be 760 to 780 to get the best rates. That's number 1. You also want to have a decent credit profile, meaning you have multiple positive aged trade lines, age being at least around 2 years or more. Ideally 4 or 5 years or more, but at least 2 years will get you in the door on a mortgage. Multiple meaning a ground floor of about 3 or 4 trade lines. The thicker the profile, the better. DTI, this is a sleeper. Debt to income ratio. Amount of debt reported on your credit report that you have monthly payments on versus your monthly gross income. This means you have 2 levers within that one metric. You can either lower your debts or increase your income, or both, if you want better affordability in the housing market. You will be astonished if you play with an affordability calculator how much $5,000 more a year in income can do, or $5,000 less in debt can do in a year. You'll be astonished. Doesn't sound like a hell of a lot. You can do a week or two's overtime at $12, $13, $14 an hour, an hour or 2, a few hours a week, and get to $5,000 a year. It's not insane. It's not anything crazy. We're talking about a little over $400 a month. I'm not making it sound like complete chump change. For some people, that's pretty impactful money. But I'm telling you that it's doable. Like overtime, tips, however you want to try to get your hands on that. Another $5,000 can mean tens of thousands of dollars on affordability. Why? Because that $5,000 is being calculated out over 30 years. It's being presumed you're going to have that for 30 years. So it's a very powerful shift. And I'm just using that as a magic number. That applies to any increase in income or reduction in your debt. So that's DTI. The next one is going to be down payment, black and white. The more you put down, the smaller the loan. Simple. You can also lower your risk factors through down payments, which can help your rate. So if you do decide to go that route, loan level price adjustments by the FHFA do penalize people a little bit for putting more money down, but it still comes out cheaper than not, okay? So those are the 3 factors that you can control in affordability. And if you dig into those deeply and find out which one of those you have the most influence over, can you make significant boosts in your credit? Can you make a significant dent in your DTI to the good? Or can you put a significant lump sum down? If you had to choose, if you have the cash, and you're choosing between down payment, DTI, paying some off on your credit, most likely DTI will serve you the best. Believe it or not, you will get a better affordability response out of DTI. If you can increase your income or lower your debt or do both, then you can get a very nice inflation in how much home you can afford. So keep that in mind. It's a little hack. What's the next thing that you can do to influence rates to the good? I said I'd give y'all a quick bonus before I let y'all get out. I didn't want this to run too long. Getting grants or incentives from the lender that you're working with, and then getting closing cost assistance from the seller at the same time. Because if you have money down and you're getting closing cost assistance, and let's just say you're getting a $2,500, $5,000, or whatever grant from your lender, or your local municipality's got some kind of grant program for first-time homebuyers, whatever, that means you're most likely going to have more than you need at the closing table for down payment and closing costs, which means you can get that applied to that rate and buy it down. It's not a crazy drop, but it helps. You can be talking about 0.25%, 0.3%, something significant enough to maybe chip away at that payment or increase your flexibility as far as the payment. So at this point, of course, you already selected the home. So I'm not really going to say affordability per se, but you can get your payment down. So something to keep in mind. This is one advantage of rates being up and people not being buyers being in the market, is sellers are way more open-minded to seller concessions, while institutions and lenders are still fighting for business by providing grants and incentives towards closing costs and down payment assistance and things of that nature. Put those together in a pot and you can increase your affordability by tens of thousands of dollars. I promise you. I'm telling you, somebody who deals with these numbers on a daily basis. You can play with it on a mortgage loan calculator or a mortgage affordability calculator yourself. Don't just take my word for it. It's a big deal. So I wanted to bring this to you because I want to continue, as always, on this channel to empower you to make room for your growth to prosper regardless of the economic or political conditions around us. I want you to have the financial tools, education, and direction to still empower yourself. Rates are through the roof compared to where they've been the last 5, 7, or 10 years. Does not mean that you can get pushed out and don't have any influence on getting yourself back in the door on the homes that you really want. So look and see which one of these factors you can control. Put it to good use. Don't just watch this video for entertainment purposes, though that's fine. I want you to put this information to use to better your situation. Comment down below and let me know which one of those 3 is the most impactful for you, and that you have the best ability to leverage for your personal situation if you're in the housing market or you plan to be in the near future. As always, to all my pioneers out there, I want you to stay focused, stay in motion. I'll see y'all soon. This is JP from Blueprint for Prosperity Network, a channel dedicated to helping you increase your net worth through relationship banking, maximizing your borrowing capacity, the proper use of life insurance, and the ownership of real estate. Like the video, subscribe to the channel. I'm uploading content on a daily basis to help you customize your blueprint for prosperity.